This is
Ascential.
This is Ascential Audio.
Welcome to the MoneyPot, our podcast at Money 2020. I'm Sanjib, Kalita, the editor-in-chief at Money 2020, and I'm joined by Rachel Morrissey, a content producer in the U.S. Hey, Rachel.
Hey, Sanjib. How are you?
Sitting tight in Virginia, doing a lot of stories for our Fintech Fightback series. Yourself?
Doing the same in Brooklyn. I always say I have a face for radio, but hey, any way to talk about these stories is good. People are submitting stories from everywhere.
Yep, which is really exciting. This week, we received a story from Dushyant Sharawat, which we thought was incredibly useful at this time.
He sent us an analysis of how each fintech sector would perform over the next 30 days, 90 days, and beyond. It was very thorough. So we wanted to talk about it and the expectations that they have. Dushyant, who gave us permission to call him D, is the Director of Strategic Insights and Advisory over Fintech Investments at Rosenblatt Securities.
Rosenblatt Securities is the largest floor broker on the New York Stock Exchange. They've been involved in both the public and private markets and have helped fintech companies through raising capital, pursuing M&A, and participating in IPO equities. In the analysis, they show how the private market lags behind the public market. They started by analyzing the top 26 publicly held fintech companies listed on NASDAQ and the New York Stock Exchange. These covered 6 different fintech sectors, and it was sobering news.
In the 52-week period from March of 2019 through March of 2020, the 26 publicly held fintech companies had vastly outperformed the S&P 500 and even NASDAQ. Since March through April, when the dislocation happened, when the market sort of fell overall, the fintech companies, the publicly held fintech companies, did much worse than the S&P 500 and NASDAQ. So they have done very well in good times, but unfortunately they've been more susceptible to business conditions and they've been hit worse, the publicly held fintech companies.
So the fintech sector lagged behind initial stock market falls, but when they did start to falter, it wasn't great. But the private sector has held so far.
Yes, but the nature of the private sector is to lag behind the public sector for 2 to 6 months, so we can't claim all is well just yet. And that applies to the recovery as well.
Yeah, after the 2008 recession, should I even call it a recession or a crash? Or recession seems too light and depression seems too harsh. And crisis has a whole new context. So we saw this in 2008.
Yeah, the public markets started to recover in the first quarter of 2009, but the private markets took about 6 more months to begin to recover. So we'll be keeping an eye on those, even though they're much harder to track. Dushyant points out that they're much less transparent.
Right. We can see how public markets are performing on nearly a daily basis. Information on liquidity and the free flow of information is very different.
So Dushyant explained how they analyze the private market.
The private market performance metrics are usually looked at more around, yearly performance. So on the private market side, there's a term like like in the wine industry, what's the vintage year and which vintage years have done well. And on the private market side, usually what happens is the vintage years, when there's a market disruption on the public market side, that vintage year tends to perform really badly, and the year prior to that. So if in this situation, 2019 and 2020 vintage years are going to be tough in terms of any companies that are incubated or funded in those 2 years, but the 2 years following, the 24 months following a market downturn, and performance measures are very good for those years. So if things start improving, then 2021 and 2022 are going to be, any companies funded in those 2 years are going to do quite well in the longer term.
I love this comparison of the private market to the wine industry. In wine, a grape that survives a bad year makes a very good wine. I think that makes this a very good parallel.
Well, I can see that. Companies that survive this are obviously going to be stronger. But one thing that struck me about the analysis was his prediction that being big didn't inoculate you from serious problems. In fact, in some ways, it made you more vulnerable.
As far as the startups are concerned, Dushyant sees what he calls a barbell impact, hitting the very small and the very large.
On the valuation side, we think that early stage companies, so anything that's Series A and prior, as well as late-stage companies, the unicorns, private companies more than $1 billion in valuation, will be hurt the most. In particular, the unicorns, we think, might have almost a 20% hit to their valuations, which could wipe almost about $75 billion of market cap across the 58 unicorns that are in the fintech space globally. So we think that it's going to be like a barbell impact in terms of stage size. Early stage companies, late stage companies will get impacted. The middle stage companies, so firms that have raised anything between a Series B and a Series D round, their situation might slow down, but I think they will relatively do better than the other two-stage companies.
Well, recessions wipe out any inflated value. Some of the unicorns are simply going to be anchored more in reality. But wiping out $75 billion of market cap across 58 unicorns is no joke.
It definitely isn't, and it could be a major dent to some of them. But the smaller companies are the ones that probably won't survive. It just shows how important timing is.
And that is just a little bit of luck.
So that is the big picture that he discussed, but he also talked about 6 different sectors, the first one being challenger banks.
What on the challenger bank and the digital lender space. Those two models, we think, will be the most sensitive to changing economic conditions, and we expect business conditions to hurt those two types of firms the most, challenger banks and digital lenders.
So this confused me at first. Challenger banks like Chime are reporting record signups. N26 has gotten an extra $100 million in investment. Others are also reporting success, buying other companies and seeing this as an opportunity for growth. I mean, it seems like the challenger bank side would be flourishing during this time.
But you and I have spoken about there being problems in their business models. Also, challenger banks don't see each other as a real competition. They see the big banks as the ones they're disrupting. But Dushyant points out that this really isn't how it's working.
The two problems we have in the space are, first is there's just been too many challenger banks, too many Me Too companies that have been funded in the challenger bank space. I think we need 5 or 10 challenger banks. We don't need 80 to 100. So a lot of marginal players have gotten funded in that space. That's going to impact the ability for those marginal challenger banks to keep acquiring customers. So that's kind of point number one. Second thing is, when a lot of the challenger banks began 5 to 7 years ago, the delta, the difference between the incumbent financial institutions, the Chases, the Bank of Americas, the traditional bank was many light years or a couple of years behind these challenger banks in terms of cost, convenience, capability, user experience. That gap has vastly narrowed in the last 2-3 years. The Chase through Zelle, Bank of America, even Merrill Lynch, Goldman with the Marcus offering, they are now not the kind of banks they were 5 years ago. So they have actually improved vastly and caught up with the challenger banks. So today, for you and I or our children, it's not just the millennials flocking to a challenger bank. They are equally finding attractive to go to the mobile offering from the large incumbent bank.
So the ones that I mentioned are probably those 5 to 10 challenger banks that will actually grow through this. But a lot of the others will definitely struggle. We predicted it would be a tough year for challenger banks anyway, but we obviously didn't see anything as brutal as this.
And he makes a great point about the big banks. They had money, time, and customer base on their side, and now their digital offerings rival many of the others, or at least are good enough to keep their customers happy.
I remember reading an article in Forbes by Ron Shefflin about this, and he conveyed a conversation with a friend who said that his daughter's politics were to the left of Bernie Sanders, but she banked with a giant bank because the combination of digital and physical convenience was too hard to beat.
Right. So the ones that are being the most creative, getting fastest growth, and have business plans that look to be profitable soon are the ones that will thrive. It doesn't look great for the others.
The next sector that Dushyant said would struggle surprised me too. He pointed out that Robo Advisors would have problems.
Robo Advisors, we think, are going to be the next to be hit. Robo Advisors make most of the money as a percentage of fees on assets under management, usually between 20 and 30 basis points. And there, the combination of markets coming down as well as redemptions are both being, negatively impacting Robo Advisors. We've already seen a prominent robo firm, Motif, shut down last weekend. They were valued at north of $500 million. They had over $868 million in assets, and they still couldn't survive and decided to shutter. So that says something quite negative about the robo-advisor space.
This didn't really surprise me. The play of robo-advisors is that they can work so much faster and their volumes can be so much greater that they can work on much slimmer fees. But with a huge market shift like this, they have to be taking a lot of losses. It isn't a normal downturn.
Right. I mean, this isn't a dip or a simple correction. It makes it difficult to assess. But as you said, companies that seem to have plenty of assets can't see a way to make it through.
Now, as a payments geek, that sector is something that I've been looking at. We've been hearing more about payments in the news than normal.
Yeah, particularly contactless payments. They are being advertised like a perk of shopping.
Yeah, they have. But the payment activity has to be down, and that's exactly what is happening.
Overall payment volumes are down due to non-discretionary spending grinding to a halt. But the shift to mobile payments and online transactions is obviously driving up volume. So we're more hopeful for this sector. So payment space, like I said, relatively will do much better than Robo Advisors, challenger banks, and digital lenders. And there the situation basically is, like I said, overall payment volumes are down. Visa and MasterCard are disclosing almost about 15-20% decline in non-discretionary spending. So, we're not flying, we're not traveling, we're not going to hotels. The whole service industry is down. Retail, clothing, everything is down. Only thing that's up is, essential items, obviously. So groceries and all of that is still doing quite well. So net for the next 30 to 90 days, and if the economic conditions remain tepid for the next 12 months, unemployment is north of 10%, that negatively is going to impact the payment space in terms of transaction volume.
Like he says, payments is a volume game, but I think payments are going to take technical leaps and bounds. There will be a massive adoption of embedded payments, and the industry is going to be much stronger. And in general, Dushyant believes that fintech will be much stronger.
I will say, though, and particularly in the fintech space, the bright spot in the payment space is there are a number of longer-term trends in payments, one that I'll mention in particular, that remain intact despite the COVID situation. So there's this whole idea of embedded payments. So the idea is basically software vendors in every vertical sector that are now embedding payments, just how Uber and Lyft embedded payments in the ride-sharing experience. That's been a longer-term trend that's already in the works in the last 12 months. It's going to continue forward in the next year despite all of this COVID situation. So we're seeing a lot of activity amongst investors still investing in the tools and infrastructure to enable payments to be embedded easily through any kind of firm that's offering products and services to clients.
Well, the payment space is going to soar after this. I think the wine analogy particularly works here. It may seem a bit harsh now, but it will come back stronger.
Despite the struggles or setbacks, there are still a lot of spaces where innovation will flourish. Dushyant ended the interview reminding me that the circumstances that encouraged fintech still exist.
And let's not forget why the whole fintech revolution began in 2009 timeframe. It was because incumbent institutions, like we just talked about, were not fully fulfilling the needs of customers, whether it's in the retail space or the institutional space. They were not delivering low-cost, personalized, convenient products to customers. And that's why pioneers like the founders of Stripe or Square, started fintech businesses in the first hand in 2009, 2010 timeframe. So I think amidst all this doom and gloom, let's remind ourselves the broader fintech growth engine will survive and I think even thrive through this downturn.
Exactly. There are lots of sectors doing well, like cybersecurity, anything that enables remote workers to function, and the insurance space. They're going to see a lot of investment. And we want to mention that Dushyant and Rosenblatt Securities are doing a webinar on the 20th of May to go into this research and explain it in more depth.
Yes, it sounds like it will be a really insightful experience for anyone interested in fintech.
Well, that is it for this episode of the MoneyPot. Thanks to Dushyant Sharawat for speaking to us today. And we want to thank our producer, Roland Bodenham.
If you like our show, please leave us a review in iTunes. And remember, you can also send us your ideas of stories for our show on Twitter at Money2020. Thank you.
This is
Ascential.
This is Ascential Audio.